Hi everyone. Let's start a new chapter. In this chapter, we're going to study interest rates. There are a couple of major topics that we need to cover in this chapter. So, number one, we need to study the factors that's going to have impact on the level of interest rate. The second topic, we need to study the determinants of the interest rate. Then we're going to study the term structure of interest rate and also call it the yield curve. And then number four, we're going to study the pure expectation hypothesis. And then lastly, we're going to study some macroeconomic factors that affect interest rates. So our first topic, the factors that are affecting the level of interest rate. So in corporate finance, we say these are the factors that have impact on the level of interest rate. So production opportunities, time preference for consumption, and then risk, and then lastly, the expected inflation. Okay, so let's use an example to illustrate why we say these are the factors that affect interest rate. Let's suppose we are in an isolated economy. So how do you define an isolated economy? Well, economy that has no connection with the outside. So if we're on a remoted island somewhere in the Pacific Ocean, we have no communication, no transportation to the outside whatsoever. And that can be an isolated economy. So on this remoted island that everybody has to go fishing uh, to be able to survive. So everybody has to go out and catch fish every day to feed themselves. So let's suppose everybody needs at least one fish per day to be able to survive. And then one day, a genius like me came up with the idea, well, I can design a tool that helps me with fishing. Say, let's call it a fish pole. So if I can successfully design and complete this fish pole, this is going to increase my fishing efficiency by 10 times. But while I'm developing the fish pole, I need to focus on the fish pole, so I have to work on the fish pole full timely. That means I cannot go fishing in these, say, 3 days while I'm working on the fish pole. But I have to be able to survive, right? I have to feed myself in these 3 days while I'm working on a fish bowl. I can't starve. So what can I do? Well, maybe I can turn to my neighbors and ask them if they can lend me some fish in these 3 days. And then by the time I finish my fish bowl and I can catch more fish, I can pay them back with more fish. That sounds like a good idea, right? Okay, well, because of this fishpole idea, which we say it is a production opportunity, then it comes with the lending activities, right? Because I have to focus on the fish pole, I cannot go fishing. I turn to my neighbor to borrow fish. So that's lending activity. And the production opportunities create lending activity. Okay, so that's the first factor we say that affects the level of interest rates. And the more fish I can catch with the fish pole, and the higher the interest rate I can offer to my neighbors. Okay, now suppose there are two neighbors next door, Amy and Jamie, right? These are the two neighbors' name. Amy is single. Jamie, however, has 3 kids. Okay, so if I approach both neighbors, both Amy and Jamie, asking for some fish, and who do you think is more willing to offer to lend me the fish? And which one will be easier? I think Amy will be easier because she's single and all she needs to feed is herself. But Jamie, however, has 3 kids, so Jamie needs to feed not only herself but her kids. So, in terms of the preferences on the consumption, I think Amy has more preferences of consuming the fish later. However, Jamie has more preferences on consuming the fish now. So, in terms of approaching to these two neighbors asking for loan or fish, I cannot offer the same interest rate to both, right? If I offer the same interest rate to both, it's Amy that is more likely to lend me the fish, but Jamie, it is more likely for her to turn me down. So, for a neighbor that has preferences on current consumption, then I have to offer a higher interest rate. So, to be able to get Jamie to lend me the fish, I will have to offer a higher interest rate because Jamie has more preferences on current consumption than future consumption, right? So that's the second factor that affects the level of interest rate is the time preferences for consumption. Okay. Now the third factor we say that affects the level of interest rate is risk. Why do we say risk also affects interest rate? Well, let's suppose I'm not the only genius that comes up with this fishbowl idea. Another guy who's really smart, Tommy, he also comes up with the same idea of developing a fishbowl. So both of us will have to borrow some fish and to be able to focus on developing the fishbowl. And both of us will be out there trying to borrow fish. Now, I work 3 days a week, 2 hours a day. That's it, because I need to enjoy my life. The other guy, Tommy, he works 7 days a week and 16 hours a day. So he works really hard. Now, suppose both of us go out there and try to borrow fish, and both of us use the fishbowl idea as the reason to borrow fish for the project to borrow fish. Now, who's more likely to get a favorable interest rate on the loan? Now, who's more likely to succeed in terms of completely finish the fishbowl and be able to pay back the loan? Well, is it Tommy who works really hard, or is it me who's a slacker? Well, seems like it's Tommy is more likely to succeed, right? Now, when both of us go out there trying to borrow fish, who's more likely to get a favorable interest rate on the loan? Well, it's Tommy who works harder and who's more likely to succeed, right? So that's risk, right? Because I don't work as hard as Tommy does, and there's more risk associated with my project. So in that case, the interest rate that I get on the loan will have to be higher because my project has a higher risk. So that's why we say risk is another factor that affects the level of interest rate. And the higher the risk, the higher the level of interest rates. Now, the fourth factor, expected inflation, that's also going to affect the level of interest rate. On this remote island, we're in an isolated economy. Let's say, we don't really have currencies, right? So inflation is about currency. It's about the purchasing power of the money decreases, right? So suppose for some reason the fish is getting smaller and smaller every day. Now, if that's the case, compared to when we're in a situation that a fish stays at the same size, well, now because the fish is getting smaller and smaller every day, we'll probably have to offer a higher interest rate and to be able to make our project as attractive as before because the fish is getting smaller and then you cannot offer to pay back the same amount of interest because the fish is getting smaller. You will probably have to pay more fish back and to be able to make the fishbowl project as attractive as it was. So this is without using the currency, but with using currency, we know inflation means the purchasing power of your money decreases. So you will have to offer a higher interest rate by considering the inflation. So this is why we say the expected inflation is another factor that affects the interest rate. Our next topic in this chapter is the determinants of interest rate. So let's look at this formula. Any nominal interest rate that we can observe, we can break it down to different components. So any nominal interest rate is the sum of all of these different determinants or some of these determinants. So on the left-hand side of the equation, we have the nominal interest rate. On the right-hand side of the equation, first we have the real risk-free rate. And then we have inflation premium, we have default risk premium, we have a liquidity risk premium, and then lastly, we have maturity risk premium. Now, let's explain what these different components are. So first of all, on the right-hand side of the equation, right, we observe the real risk-free rate. So what is real risk-free rate? It's the return on risk-free assets when there's no inflation. So risk-free assets, in reality, we use the treasury bills issued by the US Department of Treasury as a proxy for risk-free assets. So when there's no inflation, the return on these T-bills, that is the real risk-free rate. And normally this is a constant. It's around 2.6%. Now, inflation premium and any nominal interest rate must have this component, inflation premium, in there. Okay, so what is inflation premium? Well, it's a compensation for the investor when your investment is exposed to inflation risk. And in reality, almost all assets out there, all investments out there are exposed to inflation risk. And therefore, almost all investment or all assets return or the nominal interest rate includes a compensation for this inflation risk, and that is called the inflation premium. Now, the third component is default risk premium. So what is a default risk premium? Well, if the issuer of the investment has a default risk, then there should be a compensation for that default risk. And that compensation is called the default risk premium. And the higher the default risk is, the higher that compensation needs to be. So the higher the default risk premium needs to be. And in reality, we say all the securities issued by the US federal government do not have default risk. Okay, so that includes treasury bills, treasury notes, and treasury bonds. Okay, securities issued by other entities like corporations, like state governments, like local governments, and foreign governments, they all have default risk, and there always have to be a default risk premium in there. Okay, only the securities issued by the US federal government do not have default risk, and therefore there's no default risk premium in treasury bill, treasury note, and the treasury bonds. Okay, Now, the next one is called the maturity risk premium. So what is maturity risk premium? It is a compensation for investors when they hold a security over a long period of time. Okay? So why do we need to compensate the investors when they hold a security for a long period of time? Well, a lot of reasons, and the major one is uncertainties. The longer that time period is, the more uncertainties that is associated with that security. And more uncertainties means more risk, and therefore, the higher the risk, the higher that compensation needs to be. So the longer the security's maturity is, then we say the higher the maturity risk premium there is. Okay, use a very straightforward example. Okay, suppose you can invest your money in a 1-year bond, or you can invest your money in a 30-year bond. Okay, which one is supposed to offer you a higher interest rate? Is it a 1 year or is it a 30-year? Which one has more uncertainties? Well, apparently that's these 30 years, right? The longer you hold that securities, the more uncertainties you have. So the 30-year bond will have to offer you a higher interest rate, everything else being the same, because it has the longer maturity and therefore it should offer a higher maturity risk premium. Now, the next determinant is the liquidity risk premium. So what is the liquidity risk premium? Liquidity stands for how easily the investor can turn that asset or that security or that investment into cash. Okay, and depends on the nature of the assets. Different types of assets or different types of investment have different types of liquidity risk. Well, suppose if you're trying to sell a house or a piece of land versus you sell the same amount of stocks, which one takes longer? Well, if you ever had the experience of selling a property, a house or piece of land, well, it takes at least a few days, right? Okay. And if the other party, the buyer, will needs a financing, it takes at least a month to complete the transaction. Okay. If you sell the same amount of stocks, well, it takes only one click of your mouse. If you log on into your broker account, and all you need to do is click and sell it in a second. Okay. So apparently, the real estate, that is a type of property, has more liquidity risk because it takes longer to turn them into cash. So different types of assets or different type of investment have a different type of liquidity risk. And the more liquidity risk that asset has, the higher the liquidity risk premium the asset needs to offer. Our next topic in this chapter is term structure of interest rates, and we also call it the yield curve. Now, what is the term structure of interest rate? Well, term structure of interest rates is the relationship between the levels of interest rates and its maturity. So if we look at the graph on the slide, we have a three-term structure of interest rate, but pay attention to the coordinates. The horizontal axis is the years to maturity. Okay, so we have from 0 to 30 years. Okay, and then the vertical axis, we have the level of interest rate from 0% to more than 14%. Okay, so the term structure of interest rate is the relationship between the horizontal axis, maturity, and the vertical axis, the levels of interest rate. Okay, and basically we can pull out some data on specific securities. For example, if we look at the treasury securities, we can look at from the T-bills to treasury bonds. Okay, their maturity ranges from 1 year to 30 years. Okay, so we can get the interest rates on these securities and also their maturities and plot these data observations into these two coordinates. And then we obtain the relationship between the maturity and the level of interest rate. Okay. For example, let's use March 1980, that term structure of interest rate. And if we look at the 10-year treasury security, okay, and we can also identify the interest rate on the 10-year security based on the term structure of interest rate. Okay, so that's between 12 to 14%, it's about 13%. So what that means is in March 1980, the 10-year treasury securities interest rate is about 13%. And let's also look at another observation on the curve. In March 1980, the 30-year treasury security, its interest rate is about 12%, slightly higher than 12%. So based on the term structure of interest rate, we can almost identify based on the maturity what is the level of interest rate of that treasury security. Okay. So there are three term structure of interest rate here that illustrate the relationship between maturity and the level of interest rates on the treasury securities, okay, at those three different time. Okay, so March 1980, February 2000, and October 2008. So these three term structure of interest rate tells you at that time what is the relationship between maturity and the level of interest rate. And the graph of the term structure of interest rate, we call them the yield curve. So yield curve is term structure of interest rate, and it's the graph of the term structure. Okay. And out of those three example or three sample yield curves, the March 1980 yield curve is downward sloping. Downward sloping means, well, when the maturity is shorter, actually the interest rate is higher. Okay. When the maturity is longer, the interest rate is actually lower. So compared to the 10-year treasury security versus the 30-year treasury security, actually the 10-year offers a higher interest rate in March 1980. And that is called a downward sloping yield curve. And we also call it an inverted yield curve. Okay. Now, in October 2008, that yield curve is upward sloping. That means the short-term maturity treasury securities offers a lower interest rate than the long-term treasury securities. If you look at the 10-year versus 30-year in October 2008, actually the 30-year offers a higher interest rate. So that upward sloping yield curve, we call it a normal yield curve. And the downward sloping yield curve, like the one we observed in March 1980, it's called an inverted yield curve. And the one in February 2000, that's a flat yield curve. So it's neither normal nor inverted. Now, why is the yield curve so important? Throughout history, almost every time when we observed an inverted yield curve or a downward sloping yield curve, there is a recession that followed that yield curve. Okay, almost every time, I think 7 out of 8 times when we observed an inverted yield curve, a downward sloping yield curve, we have a recession. And then the only time that it was an exception when we observed the yield curve, we did not see a recession. but we did observe economic slowdown instead of a recession. Okay, so in economics, people rely on inverted yield curve as a very powerful prediction for recession because it came almost every time before recession happened. And the following table lists the 7 times that when we observed the inverted yield curve. And then when the recession happened, how long after we observed the inverted yield curve, we saw an economic recession. Okay, so these are the events: 1970 recession, 1974 recession, 1980 recession, 81 to 82 recession, 1990 recession, 2001 recession, and then the most recent one in 2008, 2009, the financial crisis. And then we have the dates when these inverted yield curve happened, right? So for example, before the 1970 recession in 1968, the December of 1968, we first observed the inverted yield curve. And then in the January 1970, the economic recession officially started. Okay, so it took almost 13 months, right, before the economic recession officially started. But we observed an inverted yield curve first. So we observed the yield curve in the December of 1968, and then 13 months later, the economic recession officially started in the January of 1970. Okay, and the most recent one in 2006, July of 2006, we first observed an inverted yield curve. And then 17 months later, in December of 2007, the economic recession officially started. Okay, so when we observe the inverted yield curve, it could take as long as up to 17 months for the recession to happen. Okay, so sometimes it takes shorter, sometimes it takes 6 months, like the one in 1974, but sometimes it took longer, like the one that most recently happened, right, in the 2008, 2009, right? We observed an inverted yield curve in July 2006, and after 17 months, we had the economic recession, okay? So it can take quite a while for the economic recession to officially start. But almost every time when we observe the inverted yield curve, there is an economic recession that followed. So the inverted yield curve is a very powerful predicting tool for economic recessions. And even nowadays, the economists rely heavily on the inverted yield curve to predict the economic recessions. Now, how did a yield curve become inverted? How did a yield curve become downward sloping? When the yield curve is upward sloping, it is fairly easy to understand, right? So use a treasury security as example. In the treasury securities, when we break down the nominal interest rate, we only have the real risk free rate, and that is a constant. And then we have an inflation premium, and then we have a maturity risk premium. And because it's a treasury securities, we do not have default risk premium because it's a treasury security. The Treasury Department of US federal government never defaults. So there's no default risk premium and there's no liquidity risk premium because it's treasury securities and the market for trading treasury securities is huge. It's way bigger than the stock market. So there's always a liquidity in there. So we consider the treasury securities as a liquidity risk free. Okay. So now, without the default risk premium, without the liquidity risk premium, the components that determine the nominal interest rate on the treasury security is only real risk free rate, which is a constant, inflation premium, and the maturity risk premium. Okay, so let's use the Treasury securities yield curve as example. Okay, when it's upward sloping, it's easy to understand. That's when the real risk-free rate stays constant as it's supposed to, and then inflation premium goes up or increases when the maturity increases, and also maturity risk premium increases as maturity increases. Okay, which makes sense, right? So this is the graph on the left-hand side of our slide, right? So both inflation premium and the maturity risk premium increase as maturity increase. Okay, and that way we observe an upward sloping yield curve. As maturity goes up, we have a higher levels of interest rate. Okay, now the graph on the right illustrates when an inverted yield curve happens, what is going on. Okay, so we can see that the real risk-free rate still stays constant. Okay, and the maturity risk premium also increases when the maturity goes up. Okay, so that is the light blue area on the top. So when the maturity goes up, we see that area widens as maturity goes up, okay? Which means maturity risk premium increases as maturity increases, okay? That makes sense. Now, what is different in the right graph is the inflation premium, and that's the middle one with a light yellowish color, okay? So inflation premium in the right graph decreases when maturity increases, okay? So what that means is as maturity goes up, inflation premium actually decreases. And this is typical in the economic recession. When we anticipate an economic recession, expected inflation actually decreases. And combine the three, the real risk-free rate, the inflation premium, and the maturity risk premium, the real risk-free rate stays constant all the time. And the inflation premium decreases as maturity increases, and the maturity risk premium increases as maturity increases. However, the decrease in inflation premium is more than the increase in the maturity risk premium. So the decrease in inflation premium more than offset the increase in maturity risk premium. As a result, on aggregate level, the interest rate, the nominal interest rate decreases when the maturity increases. And that is why we observed an inverted or downward sloping yield curve. When maturity increases, the level of interest rate decreases. Okay, it is not because the maturity risk premium stopped increasing. It still increases. However, it doesn't increase as fast as the decrease in inflation premium. So that's why on aggregate level, we observe a decreasing interest rate. Our next topic in this chapter is pure expectation hypothesis. So, pure expectation hypothesis says that the shape of the yield curve and depends on investors' expectations about future interest rates. So if the interest rates are expected to increase, then we do observe long-term rates are going to be higher than short-term rates, and vice versa. Thus, the yield curve can slope up or down. Keep in mind, pure expectation hypothesis, like any other economic theory or economic hypothesis, is built on some unrealistic assumptions. Okay, And pure expectation hypothesis has is very unrealistic assumption. And that is pure expectation hypothesis assumes that the maturity risk premium is zero, which is not realistic, okay? Because longer maturity securities should always offer a higher maturity risk premium than shorter one because of more uncertainties associated with a longer maturity, okay? But to be able to set up their mathematical model, their framework, then the scholars that came up with pure expectation hypothesis had to make that assumption that maturity risk premium is zero. When the maturity risk premium is zero, we can use the pure expectation hypothesis to back out to find the future short-term interest rates. Okay? In other words, in plain English, we can use pure expectation hypothesis to predict the future interest rate. Okay? Because pure expectation hypothesis says the long-term interest rate is an average of the current short-term interest rate and the future short-term interest rate. Okay? So when we know the long-term interest rate, when we know the current short-term interest rate, we can use both to back out to find the future short-term interest rate. Okay? That's why we say we can use pure expectation hypothesis to predict the future. Okay, and in reality, people do use different versions of pure expectation hypothesis to predict the future short-term interest rate. But all these predictions have their own shortcoming because they assume the maturity risk premium is zero, and in reality, it is never zero. Now, suppose you want to buy a car. That car costs $20,000. You don't have the money now, but you can save $20,000 given your salary and buy the car next year. And by the end of this year, once you save the $20,000, you can buy the car in two ways. So the dealer gave you two options. You either pay cash, so you pay $20,000 and drive the car away, and you and the dealer are even. Or you can finance to buy the car. That means you pay 50% of that $20,000 as the down payment and then finance the rest of the $10,000. And some people might ask, why would I want to finance the car if I have $20,000 to pay off the car? Well, suppose you can invest money in the stock market, which generates average 10% return a year. Now, do you want to pay the car cash or do you want to finance it? Well, we don't have enough information yet, right? Okay. But we can expect the following. If the future interest rate is lower than 10%, which is the return from the stock market, then I probably should finance the car because I can invest that $10,000 I have saved in the stock market, generate 10%, but I pay the car at a lower than 10% interest rate. Okay. If the future interest rate is higher than 10%, then I probably will be better off just pay the car on cash base and don't bother to finance it. Okay. So the question now is, what is the future interest rate on this car loan? Is it higher than 10%? Is it lower than 10%? Okay, so suppose you pay the $10,000 down payment and finance the rest of the 10,000, use a 1-year loan. Now, what will be the interest rate on this 1-year loan? And this 1-year loan doesn't start now, it starts 1 year from now, right? So Now we are predicting the future interest rate, the 1-year loans interest rate 1 year from now. Okay? Well, we can approach a bank and ask the loan officer in the bank, if I want to borrow money, what will be the interest rate? Well, the loan officer cannot tell you if you want to borrow money 1 year from now, what will be an interest rate because he cannot predict the future, right? But the loan officer can tell you two things. If you want to borrow $10,000 today for 1 year, what will be the interest rate? Let's suppose if we want to borrow $10,000 today for 1 year, the interest rate that the loan officer gives you is 4%. Okay? And the loan officer can also tell you another thing. If you want to borrow $10,000 for 2 years, starting today, what will be the interest rate? Okay? Because the loan officer can tell you both as long as the loan starts now instead of studying in the future, right? Okay, so let's suppose if you want to borrow $10,000 for 2 years, the interest rate the loan officer gives you is 5%. Now, how can we use the pure expectation hypothesis and these two loan interest rates to predict the future interest rate? Well, remember, pure expectation hypothesis, by assuming the maturity risk premium is zero, the long-term interest rate is the average of the short-term current interest rate and the short-term future interest rate. Okay? What does that mean? That means if you really want to borrow money, borrow $10,000 for 2 years, there are two options to go. You can either borrow $10,000 at 5% a year for 2 years. So that's the interest rate that the loan officer gives you if you want to borrow money for 2 years. Okay? Now, 2 years later, how much do you owe to the bank? Well, the present value 10,000 times 1 plus 5% raise that to the power of 2 because you borrowed that money, pays 5% interest rate for 2 years. Okay? Now, 2 years later, you owe $11,025. Another way you can borrow money for 2 years is you borrow that $10,000 for 1 year, pays 4% to the bank, and then 1 year later, you will roll over the loan for another year and pays the future 1 year loans rate. We call it X. Okay? And then 2 years later, how much do you owe to the bank? Well, it's the present value 10,000 times 1 plus 4%. That's the interest rate you pay in the first year, times 1 plus X. X is the interest rate, the future 1 year loans rate that starts 1 year from now. That's what we're looking for. Okay. Now, what's the relationship between these two future values? Market efficiency says the future values of these two must be equal. So the $10,000 times 1 plus 4% times 1 plus X must equal the $11,025. Okay? Now, if they are equal, we can solve X. X will be 6.01%. Okay, so that's $11,025 divided by 10,000 times 1 plus 4%, and then subtract 1. Okay, so you should get 6.01%. That is the future 1 year loans rate. Okay, so if you borrow money for 1 year but start 1 year from now, you will be paying 6.01% according to pure expectation hypothesis. Okay, now People might argue, why these two future values, why do they have to be the same? Can they be different? Well, let's see what happens when they are different. Well, if they are different, we're gonna observe an arbitrage opportunity. Okay, now let's use the following calculation to illustrate what the arbitrage opportunity looks like. Okay, let's suppose x is not 6.01%. X is 5.5, for example. Okay, in that case, if you borrow $10,000 for 1 year, pays 4%, and then roll it over 1 year from now for another year and pays 5.5%, then 2 years later, how much do you owe? Well, let's calculate that future value. Will be the present value 10,000 times 1 plus 4% times 1 plus 5.5%. And that should give us a future value of $10,972. Okay, and this will be less than the $11,025, which is the future value if we borrow money, pays 5% a year for 2 years. Okay, so in this case, a smart person like you, how will you take the opportunity of arbitrage and make some profits? Well, everyone can borrow money, use the 1 year loan, pays 4% interest rate, and then roll it over for another year, pays 5.5%. And then 2 years later, how much do you owe to the bank? You will owe $10,972, right? And then once you get that $10,000, once you borrow that $10,000 from the bank, right after you walk out of the bank, you can lend the money to someone, say lend it at 5% a year for 2 years. Okay? Then 2 years later, that someone who borrowed money from you will owe $11,025. Okay? So here we see an arbitrary opportunity. 2 years later, you're gonna collect from that guy who borrowed money from you, who borrowed $10,000 from you and pays 5% a year for 2 years. 2 years later, you're gonna collect $11,025. And then you owe the bank $10,972. Now you can pocket about $53 as a net profit without investing any of your own money because you borrowed that $10,000 from the bank and lend it right away. Okay, so it took no investment from you. And then you collect $53 net profit from these transactions. So that is arbitrage opportunity. Okay, now if you can borrow unlimited amount and lend unlimited amount, what would you do? Well, you would borrow unlimited amount and lend it at 5% a year for 2 years. Okay, and then you pocket all the profits. Now, if everyone does the same, what will happen to the interest rate? If everybody borrow money at 4% a year for the first year, and then 5.5% for the second year, and lend it at 5% a year for 2 years, let's suppose the future interest rate is the only interest rate that can float. Okay, so that 5.5% is the only one that can change. What will happen to that interest rate? Everybody will borrow at 4% a year, roll over for another year. What will happen to the second year's interest rate? Well, if everybody is borrowing and borrow as much as they can, that would drive up the interest rate. Drive up to what point would this stop? Well, when the interest rate in the second year goes up to 6.01%, then the two future values are equal, then the arbitrage opportunity disappears. And that's when this borrowing and the lending will stop. Okay, so market is efficient back in equilibrium. Okay, now what if the second year's interest rate is higher than 6.01%? Say if it is 7%, what will happen? Now, everyone will borrow money from the bank at 5% a year for 2 years, and immediately after they walk out of the bank, they will lend the money at 4% for the first year and 7% for the second year. And that way, 2 years later, they can collect how much? That'll be $10,000, the present value, times 1 plus 4% times 1 plus 7%. That will give you $11,128. And 2 years later, they will collect $11,128. They will pay off the bank $11,025. They will pocket $103 as the net profit from these transactions, from the arbitrage opportunity. And this also took them no investment. They paid nothing out of their own pocket. Now, if everybody does the same, everybody goes to the bank, borrows at 5% a year for 2 years, and immediately after they walk out, they lend it at 4% for the first year, 7% for the second year. Now, suppose only the second year interest rate is floating. What will happen to that interest rate? If everybody lended in the second year at that interest rate, then that interest rate will go down. Go down to what point? It will go down to 6.01%. Again, back in equilibrium. So whenever there's an arbitrage opportunity, the market efficiency will detect that inefficiency, the arbitrage opportunity, and the market force will act on that, and that drives away the arbitrage opportunity fairly quickly. So the market will be back in equilibrium fairly quickly. And that's why we say we can use the pure expectation hypothesis to back out and calculate or predict the future 1 year loans rate. That gotta be 6.01%, because those two future values, they will have to be equal. And that makes the future 1 year loans rate 6.01%. Now, since we have used the pure expectation hypothesis to find the future 1 year loans rate, since we have used the pure expectation hypothesis to predict the future interest rate, the future 1 year loans rate 1 year from now is 6.01%, what would you do? Would you pay the car in the full amount using cash, $20,000? Or would you finance the car, pay the down payment $10,000 and pay the rest of the $10,000 a year later with a 6.01% interest rate, and invest what you have saved, $10,000, into the stock market that makes 10% return from the stock market? I will do the second. I'll pay the $10,000 as the down payment and finance the rest of the $10,000, paying the 6.01% as the interest rate, and then invest the money I have saved, that $10,000, into the stock market that makes 10% as a return. Our last topic in this chapter is the macroeconomic factors that affect the levels of the interest rate. These are the macroeconomic factors, I always say, that affect the levels of interest rate. We say federal policy, Federal Reserve's policy, federal budget deficit and surpluses, international factors, and the level of business activities. So Federal Reserve policy, how does that affect the level of interest rate? Well, from the past financial crisis and the US government policy to save the economy from further recession, we can see that how the Federal Reserve policy affected the levels of interest rate, right? The Federal Reserve had run 4 rounds of quantitative easing to artificially lower the interest rate to stimulate the economy, right? The Federal Reserve had printed a lot of money, about $18 billion a month, and poured that into the 10-year Treasury market, which drives up the Treasury notes price and drives down the 10-year Treasury's yield. And that way, the interest rate is kept artificially low so that the borrowing cost for business and individuals are kept low. And that's a way that Federal Reserve's policy, the money supply, that changes the level of interest rate. And also the federal budget deficit and surpluses that can affect the level of interest rate. Suppose the federal government runs a deficit that must be financed. So the federal government will have to borrow money. And when they borrow, and that drives up the interest rate. And third factor was an international factor that also affected the levels of interest rate. Nowadays, the economy is on global basis and nations trade with each other, right? If the U.S. government runs a deficit with its trading partner, and that deficit will have to be financed. So this is typical between U.S. and China, and right now there's a rhetoric of the trading war. So for quite a long time that the U.S. runs a trade deficit with China, and that deficit will have to be financed with borrowing. That means that China will have to lend money to the US or China borrow the US Treasury securities from the US government. And the higher the deficit is, the more demand for the US to borrow. And that does affect the interest rate as well. Lastly, we say the level of business activity also affects the levels of interest rate. Well, we can observe that in the recession, the level of business activity is low. So the Federal Reserve's policy will have to change to lower the interest rate accordingly to stimulate the economy. In a booming economy or overheated economy, the level of business activity is extremely high. And then that also creates a high inflation. And the Federal Reserve's policy will have to change accordingly to calm down the economy from overheating. So that's why we say the level of business activity also affects the levels of interest rate. In this chapter, we cover these important topics on interest rates. We talk about the factors that affect the level of interest rate, the breakdown of any nominal interest rate, so the determinants of all the nominal interest rate, and the term structure of interest rate, the relationship between maturity and the levels of interest rate, and we also call it the yield curve. And then we talk about the pure expectation hypothesis, and how do we use the pure expectation hypothesis to predict the future short-term interest rate. And then lastly, we talk about the macroeconomic factors that affect the levels of interest rate. Thank you.